How to start investing in your 20s and 30s. Hi there, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we will share with you some of the best ways to invest in your early 20s and 30s. We will also share with you some of the potential assets that you can invest in today. If you're into these kinds of videos, then keep watching. When you're in your 20s, it can be hard to figure out how to invest your money. People have different ideas, and it's hard to know where to start. But keep in mind that you don't need a lot of money right away to be a smart and successful investor. Even if your first investments are small, the most important thing is to start investing as soon as possible. Think about your money goals. Investing has never been easier than it is now, thanks to improvements in investment technology and more options for people of all income levels. You might want to set short, medium, and long-term goals when figuring out your financial goals. You should think about what you want to do with your money and when you'll need to use it. For example, money saved for a medium-term goal, like a down payment on your first home, should be handled differently than money saved for retirement that you won't touch for 40 years or more. If you haven't set aside money for a specific goal, take some time to think about what you'd like to use it for. A good first goal for saving is to have enough money in an emergency fund to cover 3 to 6 months of living costs. After that, you might want to focus on saving and investing for long-term goals such as retirement. Choose where you want to put your money. When you're in your 20s and trying to decide how to invest money, it can help to think about your short-term, medium-term, and long-term financial needs. Once you know what you want to do with your money, you might want to set up your accounts. When you need the money often determines what kind of account you open. Immediate needs include food, bills, rent, and everything else you have to pay for every month. People usually keep this money in an online bank account along with a little extra so they don't overdraw their account. Most of the time, you don't have to pay a fee to take money out of these accounts right away, which makes them perfect for your immediate financial needs. The money you might need in the next couple of years, like for a trip, a wedding, or a down payment on a house, is considered mid-term money. It might make sense to put this money in a high-yield savings account, which gives you a better return on your money than regular savings accounts. High-yield savings accounts and other cash equivalents like certificates of deposits or CDs and money market accounts are seen as lower-risk investments, though CDs are not helpful for emergency funds because of the early termination penalties. You might be willing to take a little more risk than with a high-yield savings account for the money you'll need in 5 to 20 years. You could put the money in a high-yield savings account, a certificate of deposit, or an online brokerage account where you can invest it in stocks, bonds, mutual funds, or other types of assets. You can also mix and match the different account types. If you want to start saving for your child's or children's college costs now, you can also use a tax-advantaged 529 plan or other longer-term options. Long-term money is money that you won't need for many years. A retirement account is a great example of a good place to keep your money for the long term. A traditional IRA, a Roth IRA, or a 401k account can help you save a lot of money on taxes. Possible investments to make in your 20s. Stocks. A stock is a small piece of ownership in a company that is traded on the stock market. When you buy a stock, you could make money through capital appreciation, dividends, or a combination of the two. Stock prices can change a lot because they are traded on an open exchange, where the forces of supply and demand cause prices to go up and down. Even though stocks can be volatile and lose money, they can make money in the long run. Between 1957 and 2021, the S&P 500 index has grown by an average of 10.5% each year. Bonds. Even though bonds are not risk-free, most experts think they are less risky than stocks because they are a contract with a set rate of return. Treasury bonds, which are backed by the US government, are the safest type of bond because it is unlikely that the US government will go bankrupt. Bonds are debt investments, which means that investors pay off the debt of a company or government. The interest they pay you for lending them your money is the money you make from that investment. In addition to treasuries and corporate bonds, there are also municipal bonds, which are issued by state and local governments, and mortgage and asset-backed bonds, which are bundles of mortgages or other financial assets that pass through the interest paid on the mortgages or assets. Mutual funds and exchange-traded funds. Some investors might want to use mutual funds or exchange-traded funds or ETFs to get exposure to certain asset classes. A fund is basically a group of investments like stocks, bonds, some other type of investment, or a mix of all of these. Funds are helpful because they offer immediate diversification or protection against the risk of having too much money invested in one stock, sector, or another single asset. Funds are either managed actively or not at all. A fund that is managed passively tries to follow a certain index. An actively managed fund is one where the investments in a portfolio are chosen by the fund manager. Most ETFs are passively managed, but there are also a lot of actively managed ETFs on the market. Mutual funds can be managed either by doing nothing or by doing something. Now that you know the basics of investing, it's time to put what you've learned to use. You can use these tips to make a plan for investing money in your 20s and beyond. Find out how much risk you can take. When investing in your 20s, one of the most important things to remember is that time is on your side. You have a large amount of time to let your portfolio recover from the inevitable ups and downs of the stock market. Because of this, you could take more risks with your investments to get higher rewards, including the benefits of compounding returns. Learning how you feel about risks can help you figure out where and how to invest in your 20s so you can reach your investment goals. It's also important to know how your risk tolerance and appetite for risk match up. Risk tolerance is the amount of risk you are willing to take. Risk capacity is how much risk you are willing to take to reach your investment goals. And risk appetite is how much risk you need to take to reach those goals. When you're younger, if you play it too safe with your investments, you might miss out on some big returns. Take advantage of free money. One of the easiest ways to start investing when you're in your 20s is to join a retirement plan at work, such as a 401k. Once you've joined a plan, you might want to put in at least enough to get the full company match if your employer offers one. If you don't, you might be passing up money. And if you can't make the full contribution right away to get the match, you can still get there by gradually increasing the percentage of your salary that you defer. For instance, you could increase your contribution rate by 1% each year until you reach the maximum amount that can be deferred. Don't be afraid of other ways to invest. In your 20s, you might want to start investing in stocks, bonds, and mutual funds. But don't forget that there are other places to invest besides these markets. Real estate is one example of a non-traditional investment that some people might be interested in. If you're in your 20s and want to invest in real estate, you don't have to own a rental property, but that is one option. You could also put your money into fix and flip properties, real estate investment trusts, or REITs, or real estate investments that are funded by the public. Adding alternative investments to your portfolios like real estate, cryptocurrency, and commodities can help you spread out your risk and make your portfolio more diverse. It takes time to figure out how to invest money in your 20s. Even when you're in your 30s or 40s, you might not fully understand how some parts of the market work. But if you keep learning about different investments and ways to invest, you can get the knowledge you need to make sure your portfolio helps you reach your financial goals. And that's it for today's video. If you enjoyed this video, don't forget to like, subscribe, and hit the notification icon so you can be notified whenever we upload new videos. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.